It has been such a difficult couple of years for teachers. You've navigated some really challenging teaching environments, homeschooling, remote learning, but also trying to do that in the context of a very rapidly changing environment. And there were times where I felt I was turning around saying, well, what's next? We've just spent the last 2 years not being epidemiologists, about to spend the next little while not being military strategists. But as Michelle pointed out, the value of economics as a discipline in bringing together all of those different branches of thinking about human behaviour, I think has been invaluable. And I think the economic way of thinking as the core of how we think about human behaviour has really shown its mettle over the last little while. I've been a great advocate for keeping your eyes open for what the insights from other disciplines are. But in the end, we bring it all home. And the joy of economics and the value of economics is, as Michelle's son has found, that in the end, it's about how people behave, and it's about so many of the things that are important to us as citizens and residents of any community. I have my own story about how important teachers are. Yes, I was one of those students in a classroom who discovered the joys of economics and the fascination of economics at a relatively early age. We had a little segment of economics, I think it was actually in year 8. I had a slightly unusual high school education at University High School down in Melbourne. And I actually have a very clear memory of that moment where I suddenly went, this is what I'm interested in. And it was probably one of the first classes we had. And the class got into a big argument about whether you could have inflation in a barter economy. But the answer is, of course, no. And it took 13-year-old a little while to work out the answer to that question. But I realised from that moment that this was what I wanted to do. I didn't quite know I would end up in the central bank and worrying about whether you could have inflation. Certainly it turns out you can. And in a fast changing environment, I think those questions remain fascinating and remain important and consequential for everyone around us. And so my thanks to the teaching profession and particularly to my economics teacher back at UHS for putting me on that path. It has been a really challenging time to work out just what's going on, work out what's happening next, and how to formulate and design policy to support the economy through those challenges. And so what I'm going to do is I'm going to start by going through the economic effects of the pandemic and then talk about some of the more recent developments and the recent shocks. And so the first point I want to make is that COVID was an enormous shock. Now, economists in general and central banks in particular had contemplated the possibility of pandemics and had thought about their economic implications. But lockdowns weren't on any country's pandemic management plan prior to this pandemic. And so the actual shape of the effect wasn't expected. What we were expecting before the pandemic hit, something along the lines of the steady growth that you see in the grey line in this graph. Instead, what we saw in 2020 was the biggest contraction in GDP since the aftermath of the World War II demobilisation. There was a huge amount of uncertainty at the time. As the Governor has discussed recently, we were facing the prospect of tens of thousands of deaths in short order, mobile morgues, tens of thousands more people seriously ill in hospital, a health system that was overwhelmed, and the economy in collapse. That was what we were facing based on what we knew at the time in early 2020, in March of 2020. Now, as it transpired, the health situation improved faster than anyone expected and faster than in many other countries. So the economy bounced back very quickly, and you can see just how quickly that blue line came back to something close to what we'd originally expected, even though there were still lockdowns happening in Victoria, and then, of course, another lockdown in both New South Wales and Victoria last year. And so where we are now is that output is more or less on the trend we thought it would be before the pandemic happened. The pink line shows our most recently published forecasts, which are from May. I don't think that will change too much over the next few months. And if you look at it, you can sort of see it comes up to join a continuation of the grey line. That output that we lost during 2020 and 2021 isn't going to be caught up, but we get back to the earlier trend. And in fact, because the population is now lower than it would otherwise have been because of the border closures, in fact, in per capita terms, we've actually ended up higher than we would have been had it not been for the pandemic, which is an extraordinary outcome, and in many ways something to be very grateful for. So, as I mentioned, the health outcomes were better than expected, and that enabled the fast recovery. But what was really important here and distinguished the outcomes in different countries was the support from fiscal and monetary policy. Around the world, particularly in advanced economies, high-income economies, you saw massive fiscal and monetary policy support. And so at a time when GDP saw its biggest contraction in decades, when unemployment rocketed up to over 7%, household income actually went up. Business profits went up too, by the way. Now that's not a normal recession now, is it? Unemployment up, GDP down, but income up. Consumption fell, and that was the main driver of that fall in GDP. And it fell because people were prevented by health-related restrictions from doing the things they would ordinarily do. You couldn't go to restaurants, you couldn't go to the gym. There were so many things that you couldn't do appropriately because of the health-related restrictions. But we actually had higher incomes because the income support was very substantial. And so the difference between those two is savings, and households saved a lot more out of current income than they normally do. And that was also true during last year's lockdown. And so you can see in the bottom panel of this graph, you had these two spikes in the saving ratio during those lockdowns. And even now, well, our latest data is the March quarter, saving out of current income is still higher than it was prior to the pandemic. So households are still socking away more each quarter than they normally do. And all of that extra saving over the past 2 and a bit years has accumulated to a very large buffer of additional savings, more than $250 billion, that households could draw down if they needed to cushion themselves against a shock. Now, of course, not everybody, those savings are not evenly spread, but they are quite widely distributed. And so there are many people who have a stronger balance sheet than they would otherwise have done had it not been for this policy support. Now, underneath that spike down and recovery in household consumption was a very material shift in the pattern of consumption. Most of the spending that was ruled out by the health-related restrictions was services. Not only dining out and entertainment, but gym visits, recreational activities, travel, and certain health-related services. They were all things that were restricted. Some of that foregone spending was funneled into goods instead. Now, some of it was direct substitution. Instead of going out to a restaurant, you bought groceries and ate at home. And we saw that in grocery spending. Instead of going to the gym, people bought the fancy exercise bike. Now, some of that was not so much a direct substitution, but also just a reaction to the experience of lockdown. So if you needed to set up a home office, you were buying goods to do that. If you wanted to make the home that you are now stuck in for months on end a bit more congenial, new homewares and appliances were certainly on your shopping list. So there was this real shift away from services and towards goods. And you saw that across the world, and you can see that in this graph. And in some economies, that is still in evidence. So even if services consumption has more or less recovered to where it was before the pandemic, you're still seeing very strong spending on goods. And so there has still been this shift in consumption patterns right around the world. Now, such a large, sudden and global shift in demand was bound to pressure global supply chains. Most of the main manufactured exporters were grappling with their own COVID outbreaks, and so supply was being disrupted at the same time that demand for goods surged. Now, naturally, that led to spikes in various input prices as well as shipping costs, since these goods are generally shipped across the world. You can see that, for example, in the shipping cost line or the semiconductor price line in the top panels of this graph. And you can see the disruptions in the auto production line in the bottom right-hand panel. It also led to considerable delays in deliveries for many manufactured goods and that disrupted production. You can see that in the delivery times metric that I'm showing in the bottom left-hand panel. And it was particularly noticeable in the automotive industry, which was disrupted by a lack of the appropriate semiconductors, as well as directly by various health-related restrictions, including more recently. But more recently, we are seeing signs that this source of pressure to global supply chains is easing. Delivery times are shortening. They're still longer than average, but they are shortening up. Semiconductor prices are well off their peaks, and shipping costs seem to be levelling out, although at a high level. So things are at least not getting any worse in terms of global supply chains, and at some level they're getting a bit better, and that means they're less of a source of inflationary pressure than before, and that's a global story. Now I want to turn now back to the domestic economy, because the recovery in spending was much faster than earlier expected, but perhaps even more pleasantly surprising was just how resilient the labour market has been. Contemplating such a large increase in unemployment as we saw in 2020, there was a presumption that there would be scarring. People who lost their jobs would be affected by that for a long period of time afterwards. There's a huge literature showing a scarring effect to periods of unemployment, and it's one of the reasons why recessions are bad, is because it's not just the recession itself that harms people's welfare, it's that there's this long tail of experience, and particularly for people who are just entering the workforce in that recession. I mean, some of us who graduated into the recession in the early 90s, I mean, you oftentimes, it took a long time to launch into your career, or for those of us who grew up in Melbourne and graduated into the early 90s recession, you moved into state for your first job. And I'm still here. So, but it changes your whole life. And, for many people, that actually sets you back for a really extended period. And so it was really pleasing just how quickly things have bounced back. Many people had to leave the labour force entirely during that period, either because they just knew there weren't jobs, so they weren't looking, or they had sort of caring responsibilities with homeschooling that meant that they just couldn't be in the labour force for that period. But as soon as those lockdowns ended, things bounced back really quickly. And not only did things bounce back, but thanks to the policy stimulus that's been provided, it kept improving beyond that bounce back. The employment to population ratio, that's the darker purple line in this graph, the employment to population ratio is the highest it's ever been. I mean, this graph goes back to the late 60s. And in fact, the participation rate is also at a record high. In fact, so just before the pandemic, when the participation rate was already high, I asked the team to go back and look at the really old records going back to the war, and they realised we could actually put together at least annual data all the way back to 1910. So I can tell you that the participation rate at the moment is an 112-year high. That is a fantastic outcome, that there are so many people with jobs, so many people engaged in the workforce, and it's higher than it's ever been. And so when you consider the kinds of things we were contemplating as a possible outcome in 2020, that there would be scarring, that there would be people whose labour market experiences would be set back for a considerable period of time, this is a wonderful outcome. And for an institution who has as one of its mandates full employment, I think that there is something to be very grateful for in terms of this particular outcome. Now, consistent with this strong bounce back in employment, the unemployment rate is now 3.9%, and I can tell you the last time inflation was that low for more than a couple of months was when I was in preschool. So the share of underemployed people, the share of people who have a job but would like to work more hours and haven't been able to do so far, is back to the lows that we last saw in the mining boom. And I'm not showing long-term unemployment on this graph, but it is also at very low levels relative to its history. Because being unemployed has such severe costs on people, including to their living standards and their health, as well as their longer-term career trajectories, having unemployment this low, having so many people in jobs who wouldn't in the past have had one, is a huge positive for the community, and I hope that's something we can convey to students and to the broader public. Now, so the question is, have we actually reached full employment? It is one of our mandates, and it's quite important in thinking about what that could mean for the trajectory for inflation thereafter. One of the ways of thinking about full employment is, of course, the NAIRU, the non-accelerating inflation rate of unemployment, and that's the rate that can be sustained without wages growth continually rising. Now, you can't know exactly where that is in advance. It's invisible. You can only infer it from what happens to wages growth. Once wages growth starts picking up, you can conclude that you've hit it. There are also fancy statistical methods to infer where it might be, and which generally imply that the unemployment rate consistent with full employment is actually above where we are now. At the very least, we think we're around about full employment based on looking at data and those models. In the years leading up to the pandemic, wages growth in Australia was actually quite subdued. It was too low to be consistent with inflation being sustainably inside the Reserve Bank's target. We thought our target is between is a band of 2 to 3%, and if you think about having a bit of productivity as well, wages growth should be able to be sustained at something with a 3 in front of the decimal place. And we weren't there. We were sort of in the low 2s, and in some points actually slightly below 2. And during the pandemic, we saw a lot of wage freezes imposed, and in fact for some executives, we saw people taking temporary wage cuts, and so wages growth actually took another leg down when the pandemic first hit. But more recently, wages growth has recovered to around pre-pandemic rates, and the question is whether it's picking up enough to say that we've reached full employment and that inflation will land within that 2 to 3 target range once the recent shocks have passed through. So how can we infer that, and how will we know when that's starting to happen? We don't only look at official ABS data. We also have a really extensive liaison program. We talk to businesses, industry groups, and community welfare organisations. And when we talk to businesses, we ask them about the sizes of the wage increases that they're actually paying, as well as what the increases that they expect to pay this coming year. And both the external business surveys that we look at from other providers and our own liaison program have, over recent months, been pointing to a pickup in wages growth, not just in expectations, but in actuality. So if you look at the darkest of those grey bars, you're seeing more and more firms, 40% of firms are now saying they're paying at least 3. And that's a lot more than was the case since 2013, the previous 2 slightly lighter grey bars. And you can see from the red bar that a majority of firms now expect that they'll be paying at least 3% in the coming year. And so this is something that really turned sort of since the beginning of this year. It was something that we wouldn't yet know from the official wage data. The wage price index is for the March quarter, but the reference period was early February. And this was a story that really started to come out from our conversations with firms sort of through late February, March, April, and we started saying this is more than just a blip. This was building, and so that plus the business surveys led the board to conclude that wages growth was clearly picking up now, and that was something we were looking for in terms of our assessment of the economy. So that's really the shape of where we were landing in terms of the COVID shock. And what I want to do now is talk about the current situation and the various factors shaping the outlook from here, because it's not just COVID now, is it? So the first point I want to talk about is the uncertainty and the crucial nature of the outlook for household spending. Consumer spending was, of course, the thing that contracted a lot during lockdowns, and its bounce back was crucial to the recovery. But there are concerns that as cost of living pressures and rising interest rates could weigh on consumer spending in the period ahead, so could declining wealth, and we're very conscious of these potential headwinds. And so in this respect, we do have a little bit of comfort about household spending in Australia because of that extra saving that I talked about earlier. Households in Australia saved a lot during the pandemic because they had the income support to do so, and they're still saving more out of current income than they used to. And so there's plenty of scope to keep spending growth roughly where it is, or to allow spending to keep increasing by allowing saving to decline back to where it was before the pandemic. So not dipping into your savings, not finding the coins behind the back of the couch, but just not saving as much as you have been in the last couple of years, and saving something similar to what you used to save. And that's different to the situation in, say, the US and the UK, Well, the saving rates there are already back to pre-pandemic levels. They had that spike too, but they're already sort of eaten into that in order to maintain spending growth. So the situation in those two economies is a bit more delicate than it is in Australia. And I think this is one of the things that I've been very conscious of, is that cross-country experience is quite different depending on where you started and the different shape of the policy support that different countries had. And so even though COVID was a common shock, the energy price increases that I'm about to talk about are a common shock, how that manifests in different economies depends on that country's starting point and institutions and policy response. So I think that's something that is important to bear in mind and is a useful antidote to some of the sort of automatic extrapolation from US experience that you sometimes see in the media. Now, I guess you might want to say, well, is this saving really real? How do you know that this saving has really been accumulated? It's just 2 lines in the national accounts, both of which are fairly imprecisely measured. Well, the thing is, we can see it in other sources of information as well. And one of them is what's actually going into people's bank accounts, which we get independently from APRA. And you can see that being, those extra savings accumulating in household balance sheets. Households also increase their extra payments on their mortgages. So part of that, they just made bigger repayments than they needed to into their mortgage account, but they also accumulated a lot into offset accounts. And of course, because interest rates were low, when interest rates are low, the way a mortgage repayment works is you're paying more principal. More of the total repayment is principal rather than interest. And so all of that was contributing to sort of basically paying off your mortgage ahead of the schedule that would be required. Normally in Australia, households are in aggregate ahead on their mortgages, and the vast majority of mortgage holders have at least some buffer of extra repayments and are a bit ahead on their mortgage. But that moved significantly further over the course of the past 2 years. And I think that's something that's not appreciated, that households have built up these buffers, and in thinking about what higher interest rates might mean for their cash flows, very many people, when you recalculate what they're required, they may not actually have to increase their repayment because they're already repaying more than they need. But it is something we're conscious of. Now, households' wealth also went up during the pandemic. Not only did they accumulate these extra savings into their offset accounts or as additional repayments into their mortgage accounts, the value of the home, the value of the collateral also went up. And this was a common trend right across advanced economies. And so that also means it's another reason why household balance sheets have strengthened. And that was true. You saw some really interesting shifts within that, where there was a lot more interest in regional areas. Some of that was probably people going for tree changes, or people saying, well, if I can work from home, I don't have to actually live in the big expensive city, I can live somewhere else. But there was also just the fact that typically you have a flow of people in both directions from different population centres, and when cities are in lockdown, no one moves to them. And so there was just a big sort of interruption of the normal population flow into Melbourne in particular. And so people who would otherwise have moved from regional areas to big cities just didn't do it during that period. That meant there was more people in regional areas, and that has changed both the rent and house price configuration across the country. But more recently, the housing market has slowed, and that started happening actually earlier this year. House prices have been falling for a few months now in both Sydney and Melbourne, and the rate of growth in housing prices elsewhere has slowed considerably. But that still does come back on the back of that sizable rise, more than 20% over the previous 2 years. Now, falling household wealth does drag typically on household spending, and so the question really that we're facing now is whether the high cost of living and lower wealth will outweigh the effect of this strong labour market and the sizable buffers of extra savings. So in thinking about the outlook, what we're grappling with is how those competing forces weigh up. But of course, that's not really the only uncertainty that is weighing on the outlook at the time. And many of the uncertainties that we face are essentially unpredictable. And as I sort of joked earlier, we're not military strategists, but we do know what happens when oil prices and other energy prices go up. I mean, that is basically a negative income shock for the world. And the outcome is essentially unpredictable because, what happens from here really depends on the response of Russia, what happens to supply, what other sanctions are imposed. Geopolitical risks are always present. They're always something we have to think about as economists and policymakers, but they're something that we can't really predict when something's going to go off. And it's well outside of our realm of expertise to really have a good sense of those things until they happen. It is really beyond our powers to predict them in advance. But they are very important when they occur. And we can see now that Russia's invasion of Ukraine has resulted in a very significant increase in energy prices, not just oil and gas, but also coal. It's more evident in European markets than in Asia-Pacific markets, but there are global spillovers. As Russian gas has been withdrawn from the European market, some economies are substituting coal-fired electricity generation and for gas, and so that's lifted the price of coal as well. Russia is also a relatively big exporter of coal. And that's happened at the same time that global production of coal hasn't really been increasing because people are very mindful of the coming climate transition. And so there hasn't been a lot of investment in sort of new coal capacity, and there hasn't been a lot of maintenance of coal-fired electricity generation. And so, this has sort of limited the scope of the global energy system to adjust. Russia's invasion of Ukraine has also lifted the price of many agricultural commodities because both countries are major exporters of grains, seed oils, and in the case of Russia, fertiliser. And this has given rise to concerns about food security in some countries, particularly some of the lower income countries that are major importers of grains. And more recently, people have become focused on the fact you've got this energy price shock, and that might mean that growth globally, and particularly in the United States, will slow. The R word has been used about some economies, and I think people should use the O word as well. I mean, the US economy is manifestly overheating, and so they're just in a very different situation to us. And so since, because of those concerns and the outlook for global growth becoming more mixed, you're actually seeing some non-energy commodity prices, which initially increased in the aftermath of the initial invasion. You can see that things like iron ore, base metals, and even some foodstuffs, their prices have actually started falling again. Another element to that downturn in commodity prices is another factor that's clouding the economic outlook, and that's the ongoing spread of COVID. Now, most countries have eased restrictions, and as I mentioned, global supply chains are working themselves through and dealing with those disruptions. But China still has a zero COVID policy. And this means that some cities are going through very extensive lockdowns and other restrictions. And so this graph splits out Shanghai province from the rest of China. And you can see that when they have a lockdown, that is very disruptive to production, particularly industrial production, not only for the city affected, but also for their neighbouring provinces to some extent. Now, it is hard to know how many more outbreaks will occur. We're not epidemiologists. It's hard to know how disruptive that will be. The authorities in China are trying to adapt their restrictions so that production can continue. And so far, global supply chains haven't been that affected by these latest lockdowns in China. But it is really something to watch, and it's another one of the reasons why some of these commodity prices, particularly iron ore, being an input into steel, and China being by far the biggest steel producer in the world, this is another of the concerns around the outlook for China is another of the reasons why some of these non-energy commodity prices have fallen more recently. Now, Australia is a commodity exporter, and including energy commodities. I mean, LNG is one of our top 4 exports, and so is coal. Coal actually, in values terms, actually just pipped iron ore in the most recent figures. So the higher price of energy commodities is actually a positive income shock for us, and that's different from many other advanced economies. Canada's in a similar situation. It's a big oil exporter. The US is roughly balanced, but if you're Japan or one of the countries in Europe, you're in a very different situation, and it's a very negative income shock. So this has been a huge reallocation of income, and typically when you have that reallocation of income to energy exporters, the exporting countries tend to save more of it than the energy consuming countries would have done had energy prices been lower. And so for the world, it is a negative demand shock. And as a consequence of that sort of surge in initial surge in commodity prices, that's sort of seen as a positive for the Australian dollar. But as some of those commodity prices have declined more recently, it means that Australian assets are less attractive to financial investors, and so they allocate a bit less of their portfolios to Australian assets to something else, particularly US assets. That puts depreciation pressure on the Australian dollar. Offsetting that somewhat, interest rates on Australian dollar denominated assets have been rising relative to those on major country assets more recently, and so that makes Australian assets relatively more attractive to financial investors. And so the net of those two things, if you look on a trade-weighted basis, the black line in the top panel, the dollar's been bobbing around, but it basically isn't that different from where it was at the beginning of last year. But because financial market investors have been concerned about the global growth outlook, what tends to happen then is they tend to go into safe havens, and the US dollar is a safe haven. So what happens is the Australian dollar is depreciated against the US dollar, but not so much against other countries. And so that's why you've seen that wedge between the red and the black line open up. But I think there's a lot of you see on the news, there's a lot of reporting. Oh, the Australian dollar did this. Usually they just report the US dollar as if that's the only thing. But there are many forces impinging on that, and the exchange rate is a really important shock absorber for the Australian economy. When we had that enormous surge in commodity prices and a huge terms of trade boom and the mining boom 10 years ago, the Australian dollar had appreciated a lot. And that meant that the positive income shock, instead of going entirely just to some mining companies, it distributed itself across the community as cheaper imports. And similarly, when you have economic downturns in the world, typically the Australian dollar tends to depreciate. That's a positive for the community, where now our exports are now more competitive. And so the Australian dollar the exchange rate is actually an incredible shock absorber. And compared with some other countries and models you might see, or thinking you might see about some other countries, it's important to realise that the floating exchange rate is a large part of the adjustment to global shocks in Australia, and that can be a bit different from some other countries. Now, increased food and energy prices have boosted inflation all around the world, and you can see that in the headline line, which is the blue line in the next in these charts. And that you can see that pretty much everywhere except arguably China. But even if you exclude food and energy, and you look at so-called core measures, inflation's risen almost everywhere and quite quickly, and that's the red line in these graphs. Now, some of this relates to the spillover from fuel, so things like transport, airfares, those sort of things have gone up because of the cost of fuel. And also, food costs don't just hit your grocery bill, they also hit things like restaurant costs. But more generally, as economies bounce back from lockdown and fiscal and monetary support has boosted demand, other prices are rising more quickly now as well. And before the pandemic hit, inflation was generally lower than central banks' targets. That was true in Australia, but also in many other countries. But that isn't the problem we face now. Now, Australia hasn't been immune from these inflationary pressures, but to be honest, they've been a little later to come through here for a variety of reasons. And headline inflation got pushed around by childcare subsidies as well as things like petrol. But if you look at the trimmed mean measure, which is a measure of underlying inflation that takes out the extreme measures, you can see that has really kicked up more recently. It isn't as high as the equivalent measures in, say, the US or the euro area, but it has really picked up. We're not immune from these global forces, and domestic forces have also been important to this as well. Clearly petrol, I probably didn't need to show you a graph of this. You would be very aware of what's happening to petrol prices. And that has contributed a lot to the recent upswing. And the interesting thing is, although crude oil prices are actually off their recent peaks, global refinery capacity also got squeezed during this period, partly because some of that refinery capacity is in Russia and people aren't buying Russian oil anymore. But also there's quite a bit of important refinery capacity in China. And although during the Shanghai lockdown, China's demand for refined petrol went down, It just so happened that one of their biggest refineries is in, right next to Shanghai, so there was a bigger disruption to their supply of refined prices than to their demand. And so refined petrol prices actually stayed high for a considerable period of time. Just in the last week or so, global refined product prices have come down a bit. So it's hard to know exactly how that will manifest at the pump, because that's in US dollars, we're paying Australian dollars. But you can see petrol prices have gone up, and we do expect that to add a bit to inflation in the June and September quarters, on top of the big contribution that we saw in the March quarter. Now, back in May, when we did our last forecasts, petrol prices were below $2 a litre because of the cut to excise, but the refinery margins have sort of eaten up all of that decline. And so, we're now expecting petrol to add to headline inflation over the next couple of quarters. And so, that just does mean we're going to see a bigger spike in headline inflation than we might otherwise have expected. And, depending on what happens, in the conflict, in Russia's response to the sanctions and to Russian oil supply, that could change again. And so, we always build the forecasts on the basis of oil prices being where they are now, the exchange rate being where it is now. You can't really improve on that as a forecast for those things, but we know perfectly well that there are risks that could actually add further to energy prices from here, at least in the short term. I mean, I think one of the things that I'm sure your students will be interested in is this sort of shock is bound to accelerate the climate transition. Getting off hydrocarbons isn't just an issue about the climate anymore. It's a matter of national security for some countries. And so things are going to change much more rapidly than we might have expected 2 years ago. So global factors are clearly affecting inflation in Australia, but there are domestic factors as well. And one of these is the cost of building a new home, which is included in our CPI. Now, demand for new homes probably would have been strong anyway. Even though the borders were closed, interest rates were low, so the population was growing more slowly, so I think a lot of people assumed there'd be less demand for housing, but interest rates were low, and also a lot of people wanted to live in smaller households. And you might have seen in the census, just came out, and it showed that the average household size has actually gone down. And essentially people looked around at their many flatmates and said, do I really want to be locked down with you for multiple months, or do I want to move in with my partner? And you saw this switch away from large share households into people living with their partners. We actually saw this in survey data, and I talked about this back in May, and we thought, well, this is what we're seeing in the survey data, and the census will tell us whether we're right or not. And it turns out the census actually showed what we thought. What do people bring to the second lockdown is a removalist fan. So low interest rates made housing more attractive. People wanted to live in smaller households, and people were working from home. Many of them wanted, now I need a home office. Now I need a space I can work, or we can work. I mean, a couple household. They don't necessarily want to be working at the same dining room table. So all of that sort of increased the demand for housing services per household. And on top of that, we had first home buyer grants to support the home building industry, and the home builder subsidy more generally, which encouraged more demand for new homes. And so there's now a really substantial pipeline of new homes waiting to be completed. And this is pushed up against the available supply of building materials, which had been really constrained globally. I'm sure you'd heard about what was happening in global timber prices, and everything from timber to tapware was being constrained because every country was experiencing this, so building materials generally were being affected. But then in Australia, because you had this big pipeline of extra construction because of the home builder subsidy, we basically hit the limits on construction labour, and it's becoming. We talk to many construction firms, and they just say we just can't build them any faster. We're getting, and we're experiencing all these delays because it's hard to get building materials. And so the cost of new homes, building materials inflation, you can see has really accelerated relative to history. That's the green line in the bottom panel, and so the cost of building a new home has also accelerated quite quickly, and that's the orange line in the top panel. And you can see that normally does move around with the amount of homes being built, which is the blue line, but it's gone up even more. And part of that is just this pressure on the costs. And part of it is also just as the home builder subsidy unwinds, that adds back to inflation, whereas previously that had held that orange line down. Another sort of domestic factor, I think, back in May, we seem to have been relatively immune from what was going on in sort of global electricity markets. We weren't piping Russian gas. We weren't seeing the same effect on our electricity bills in May that you were seeing in the UK and continental Europe. And so we certainly weren't expecting what we saw subsequently. But there is not time to go through what happened in the electricity market over the last couple of months. But several things happened at once to create this situation. We had bad weather cutting renewables generation at the same time that coal-fired generation was being disrupted by maintenance issues and the increased cost of coal. So the input had gotten more expensive, so coal-fired generation really had to increase, could only really supply at a higher price. But also because, electricity producers know that eventually we'll be moving away from coal, they're not really investing in maintaining their coal-fired generation. So things break more more often. And so, a few things broke in the coal-fired system at the same time their costs went up and at the same time that renewables generation went down. Now, gas-fired generation was able to expand to fill the gap, but it's higher cost than some of these other sources of electricity production. And so the net result was much higher gas and electricity wholesale prices. Now, these don't flow through to the electricity bills of households and businesses immediately. There's sort of big fixed costs of network access. Most businesses have fixed-term, longer-term multi-year contracts, so it doesn't hit people's bills immediately. But electricity prices are likely to increase over the course of this year, and we are factoring that into the outlook. And there's already been announcements by various providers that their sort of market offers are for retail electricity have gone up. And there are some small retailers who've just said, we actually can't make money at the current prices, and are telling their customers to maybe consider switching. And we've also been mindful that other prices have been rising quite quickly. Grocery prices have been affected by the floods. While this will pass over time, it's clearly very salient in everyone's mind. So, normally when I, attend kids' birthday parties or barbecues or other social functions, people want to ask me what's going to happen to interest rates. But for a few weeks there, all they wanted to talk about was the $12 lettuce. It should pass through over time, but at the moment it is adding to inflation, and the more disruptions we have, as you can see, it was rain. You wouldn't know it from today's weather, but there's been more flooding. I think there's going to be more fruit and veg disruption over the next couple of quarters, and that will take a little while to unwind. So you can see what's happened to grocery prices in the March quarter, and we're expecting another big one in the June quarter. You can also see in the top right panel, consumer durables prices have been affected by global supply chain issues, and that's unusual. Normally durables prices are flat to falling. So to have such a period of, it's not massive inflation, but it is actually positive, and that's unusual, and so that's adding to inflation more than it normally would. And similarly, market services and rents used to be rising very slowly, but there are signs that both are picking up as the economy strengthens. And so these are all things to watch and things that we're very mindful of in thinking about the outlook from here. Which brings me to this graph. When the pandemic hit, the RBA put in place a very accommodative monetary policy to help support the economy and to provide insurance against the worst possible outcomes. As I mentioned, if you think about what the health situation was likely to be, what we were looking at the brink of was really serious. And the health advice at the time in 2020 was, well, no one's ever developed a coronavirus vaccine. So the idea that you'd have, 6 effective vaccines by the end of the year was just, certainly not something that we would have envisaged. And certainly not that Dolly Parton would fund one of them. Things, if you'd written that movie script, Hollywood would not have bought it, even if they wanted a vehicle for Dolly Parton. And so, things were expected to be much worse than they actually turned out. So it's a really good thing that things turned out better than we feared. There are so many people who are alive now who wouldn't have been if we hadn't been able to get control over the virus, if we hadn't been the beneficiaries of all the medical research that happened and brought forth all these different vaccines. And unemployment's at 3.9%. So I think we should be sort of relieved and grateful that that's where we stand. But the current situation is one of high and rising inflation, as well as low unemployment and solid growth in spending. So the economy's been really resilient. And the resilience of the economy and that high inflation mean that Australia doesn't need emergency levels of monetary stimulus anymore. And so what the board's been doing is taking out this stimulus that isn't needed anymore. And the board does expect to take further steps in the process of normalising monetary conditions in Australia over the months ahead. Now, how big those moves will be and exactly which month they'll do what is going to be guided by the incoming data and the board's assessment of that outlook, that very uncertain outlook for inflation and for the labour market. And the board is committed to doing what's needed to ensure that inflation in Australia does return to target over time. Given the uncertainties, it's very hard to know exactly how quickly that will play out. You know, our forecasts are always our best estimate based on what we know at the time, and things will always change. And I think, you know, the last 2 years, I mean, I've presided over the biggest forecast errors the bank has ever perpetrated. So, you know, you have to be humble about what you can know. But what economics brings is you can at least sort of play out in your mind what the consequences of certain outcomes would be. And that's really what we're trying to do now. So I just want to thank you for your attention, and I'm certainly open to your questions about this material or anything else. And thanks very much.